For decades, we've been told that markets are driven by the collective wisdom of millions. But what if that's all wrong? What if the market isn't really the one calling the shots at all, but instead it's the financial health of just a few key institutions? Well, in this explainer, we're going to dig into a fundamental shift in thinking that changes, well, pretty much everything you thought you knew about finance.
All right, so this whole idea really boils down to one central question. With all those trillions of dollars zipping around the globe every single day, who is really on the other side of the trade? Who's the one actually setting the price for taking on risk? Because, the answer to that question completely changes the game.
And this slide, this perfectly lays out the two different universes we're talking about. On one hand, you have the classical, textbook view of a theoretical average investor. It's a neat idea where prices just kind of reflect the overall risk to all of us. But then there's this new, modern view, which is what we're digging into. It says, nope, forget that. It argues that prices are really being set by hard limits, the actual cash and balance sheet capacity of a few very specific, very large institutions.
So here's our roadmap for today. We're going to start with that old model, then we'll see where it started to show some serious cracks. After that, we'll meet our new main character, the financial intermediary. And finally, we'll connect all the dots to see how their balance sheets are the real engine driving prices, giving us a whole new lens on the financial world.
Okay, first up, let's get our heads around the idea that was king for so long. It was super elegant, really. The core concept was to take this incredibly complex market with millions of people and just boil it all down. Simplify it to the actions of one single theoretical person.
And this theoretical representative investor was the bedrock of everything. The idea was pretty straightforward, An asset was considered a good bet if it acted like an insurance policy for the whole economy. If it paid you when everyone else was struggling and cutting back on spending, it was worth more. It was a really nice, clean way to connect Wall Street to what was happening on Main Street.
But here's the thing. The real world is never that clean, is it? It's messy. And pretty quickly, people started noticing all sorts of weird things happening in the markets, things this beautiful, elegant model just had no answer for. The theory was great on paper, but reality, well, it wasn't playing by the rules.
So check this out. These weren't just small hiccups. They were major puzzles that pointed to a much deeper issue. The old model assumed, if a price is wrong, someone will just jump in and fix it. But in the real world, arbitrage has its limits. And the model totally missed how leverage could pour gasoline on a fire, or how liquidity, the ability to buy and sell easily, could just vanish right when you desperately need it. All of this pointed to one huge thing. Real-world constraints were running the show. So this is the big turning point in our story. All those weird anomalies, they all started pointing in one direction. If it wasn't this imaginary average investor setting prices, then who was it? Well, the answer was hiding in plain sight the whole time. It was the big dogs, the institutions that actually moved the markets.
And here's the key takeaway, right? We're throwing out the idea of some abstract average Joe. Instead, we're looking at the cold, hard numbers on the balance sheets of real institutions. We're talking banks, dealers, huge asset managers. These are the folks with the firepower and the job description to take on massive amounts of risk.
This right here, this is the massive conceptual leap. All of a sudden, the health of the entire market, the price you pay for taking a risk, isn't about what people feel or prefer. It's about something you can actually measure. How much capital, how much funding is sitting on the books of these giant intermediaries. It is a total game changer.
So, you're probably wondering, how does that actually work, right? How can the health of just a few dozen big firms dictate the price of, well, everything? It all comes down to a cycle, a really powerful push and pull. Let's start with the boom times, the expansion phase. Imagine these intermediaries are just swimming in cash. Their capacity to take on risk is through the roof. So what do? They go on a buying spree, competing with each other for assets. That competition pushes prices up, makes borrowing cheaper for everyone, and means you get paid less for taking on risk. Everything looks rosy. But as we all know, what goes up often comes down. This is a two-way street. Now imagine those same firms take a big loss. Suddenly, their capital is scarce. Their ability to hold risk just collapses. They're forced to do the exact opposite. They have to sell, they have to de-risk. And that's when you see borrowing costs explode, risk premiums shoot up, and asset prices crater. And just like that, all those old puzzles we talked about, they suddenly click into place. You know that crazy volatility that economists used to call irrational? Well, maybe it's not so irrational after all.
Maybe it's just the market literally breathing in and out, expanding and contracting, right along with the balance sheets of its biggest players. It's that forced buying and selling that creates those wild swings.
Now, thinking this way isn't just some dusty old theory for a classroom. It has huge, real-world consequences. It fundamentally changes how we should be thinking about financial stability, about regulation, about the entire design of our financial system.
So why should you care about any of this? Well, it means that those boring financial rules, like how much capital a bank has to hold, aren't just for bankers. They have a direct impact on asset prices. It means when the Fed changes interest rates, it's really affecting the funding costs for these big players, which then ripples out to everyone. And most importantly, it tells us that if we want to avoid another 2008, we need to focus on one thing: making sure these intermediary balance sheets are rock solid.
So let's leave it with this one. Really powerful thought. The old way of thinking saw risk as just a number, something you could pull from a spreadsheet. But this new perspective tells us that risk is actually institutional. It's born from leverage, from funding, from real-world constraints. It's not about who wants to take the risk, it's about who can. And that, right there, is the secret to understanding how finance really works today.